When I turned 18 on my birthday, my father bought me one stock. I'll keep it forever. My holding period is forever, as Warren Buffett says. I've been, like every kid at university, very excited about day trading. Extremely risky though. Two analysts can look at the same chart and they can tell you completely different things from the same chart. One can tell you buy, the other one can tell you sell. Warren Buffett, again, he had a bet with a couple of hedge fund managers that in 10 years' time, they will not beat the market.
You can sell stuff at the food market, you know.
Yeah, absolutely. I would love to go and be a lifeguard in Australia on some remote beach and let my portfolio work for me. Money never sleeps, as you know. My portfolio has been growing steadily. Funny enough, I've been only buying. I don't know where's the withdraw button on my account. I've never used it. But money in the stock market is like a soap. The more you touch it, the more it starts to disappear. House long-term real estate is earning less than the stock market. I remember my first bank check with my first dividend, which was something like £10, which came to my post. I opened it and I saw £10 and it was the greatest feeling ever. If you invest in a global fund, because the US stock market is so big, 60% of your money go in the US.
I personally done these kind of mistakes when, you know, I buy a company and it goes down and then I wait for it to go up and it doesn't happen you know, for years.
Exactly.
I have a lot of people who are asking me, what do you think about Nvidia? What do you think about Netflix? Hi everybody, it's Dimitar from Dimitar Money and I have invited my good friend Chris from university.
Hey guys, thank you for the invitation, Dimitar. Nice to be with you.
Thank you, Chris, for accepting this invitation. And we are here with Chris to talk about finance, investments. Chris has been my colleague at the University of Manchester from 2009, and he has been doing investments for how many years?
15, 16 years, quite a while.
So that's a lot of experience, and I'm sure you have a lot of lessons, a lot of things that you have learned throughout this time, and hopefully you'll share those experiences with us. A little bit about Chris. Chris likes to travel. He visits different parts of the world. And he invests regularly, every month actually.
Every month.
For the past 15 years. And he lives in London, in Canary Wharf. He works in a bank.
That's right.
Yes. So Chris, let's tell us a little bit about yourself, about, you know, what's your current situation right now? Do you, because, you know, as you know, some of the markets are at all-time high. Do you still invest or do you wait? What's your strategy here?
Of course. So a little bit about myself. I'm born in Burgas in Bulgaria. I went to study finance in University of Manchester when I was 19. After this, I started working in London. I've been working at the London Stock Exchange, HSBC, Credit Suisse, which is now gone, as we know, and now Citibank, which hopefully won't be gone anytime soon. But yeah, as you said, I'm investing quite often. My investment journey started when I was 18 years old, I think. When I turned 18 on my birthday, my father bought me one stock just to get me started on the journey. And I still remember this stock is called Himimport. It's a Bulgarian stock which has been still operating, by the way. It's been giving dividends for 15, 16 years by now.
Do you still keep that stock?
I still have the stocks and I'll keep it forever. My holding period is forever, as Warren Buffett says. I won't sell it because it's close to my heart. It's a personal milestone, the first one. After this, I've been trading a little bit. I've been, like every kid at university, very excited about day trading and scalping the market and trying to get quick profit. And now I'm much more mature investor, much more boring as well, some people can say it, but I follow a long-term strategy, again following the wisdom of the greats like Benjamin Graham back in the day, Warren Buffett, Charlie Munger and so on, and staying in the market for the long term.
You know, when it's exciting, people tend to get carried away with emotions. Have you had this kind of experience in the past, you know, when you were younger? Did you carry it away with emotions like fear and greed?
Of course, yeah. As a kid, when I started trading at university, I was doing day trading with platforms like Trading 212, Plus 500. So these are platforms which use a lot of leverage. Maybe you can use up to 100 times leverage.
What is actually leverage? What is that?
Leverage. So leverage is basically borrowing money to multiply your position. So let's say you have 5 times leverage. What you do is you invest $1, but you actually borrow the rest of the money, so you play with $5. The issue with that is that any type of move is multiplied by 5. So if the market moves 1%, you move by 5%. So imagine if a stock falls down by 20%, go to zero.
Wow.
So it can be fun. You can make very much money quickly. Extremely risky though. So not up to my taste.
So what happened with that day trading? What lessons did you learn? Do you do day trading now, or you moved to long-term investing? What did you do?
No longer day trading for me. It takes quite a bit of time. It is very risky because most people do it with leverage, and you have to follow the stock market pretty much all the time. So you cannot chill. You cannot do a long-term research of a company and so on. You can still do it, but you try to catch very short moves. So many people use technical analysis for it. Now I'm more of a fundamental analysis guy. Like your video for Google was very helpful actually on the similar mindset to analyze a company, to see the fundamentals, to check the market. While day trading, I was mainly using technical analysis, looking at charts, patterns, graphs, different indicators.
Candlesticks probably.
Exactly. Elliott waves was one of them. Fibonacci levels. Candlesticks was very, very useful as well. And I was following a lot of advice on Twitter, those platforms which many people share all the time, kind of prediction for their day. The issue there is that I have zeroed my account at least 3 times. Obviously with small amounts, but as a student, even a small amount is a big one for you.
Yeah.
But I was trading aggressively. I love to trade metals. I trade a bit of energy, like oil, trade a bit of forex currency like everyone did. And I tried to catch the moves, but technical analysis is a very risky one. And 2 analysts can look at the same chart and they can tell you completely different things from the same chart. One can tell you buy, the other one can tell you sell. So it's subjective.
Very subjective. After this day trading, when did you start that transition from short-term investing to a long-term investing?
Yeah. When I started my first job at the London Stock Exchange, I noticed that I'm receiving a bit of a private pension. And I started being interested, what is this pension doing? Is it just sitting in a bank account, or is it actually invested somewhere? And I noticed that it's invested in a long-term passive fund. I believe it was in a UK stocks, in FTSE 100 fund. So I started thinking, I have some savings in my bank account. They're earning a very small interest, and they could be locked as well, like 1, 2, 3%. How can I make a bit more money without taking the risk? Because now I'm earning some money. I can spare some money every month and try to invest it on a consistent basis. So I started investing with very small amounts. My first one was 50 pounds, 100 pounds, and every month putting some money on the stock market. And I started investing initially I started with active funds, and I started following some money managers, which I believed were smarter than the market. They could beat the market. They were charging a higher fee though, 1%, 2%, something like this.
So that fee in the long term, it's your returns, right? Over 20, 30 years period.
Absolutely.
It's your return. That's why passive investing in ETFs is the better option long term.
Much better, yeah.
What were those fund managers doing? Were they beating the market? Were they generating some good returns? What happened with?
The interesting thing is, so I'll give you 2 examples. The first one is that there's a research that 90% of the money managers, of the asset managers, portfolio managers, they cannot beat the market. They cannot overperform the market. Simply they think they're smarter, they pick stocks, but usually the market is doing better than them. Another one is Warren Buffett again. He had a bet with a couple of hedge fund managers that in 10 years' time, they will not beat the market. The bet was still on after 6, 7 years, and the market was so much better than the hedge fund managers that they gave up and they told Warren Buffett, yes, we cannot beat the market. The other thing is fees. They charge fees. If they charge you even 1%, 2%, as you say, this is eating away the compounding of the returns in the long run. So they cannot beat the market.
Compounding, you mentioned. What is compounding? What does it do?
Yeah, compounding is basically in the long run, your money gets multiplied with time. So they grow like a pyramid. They go exponentially higher and higher. This happens because let's say this year you earn 10%. this 10% gets reinvested.
Okay.
Then you earn money on this 10%. So the money starts to work for you with time. And compounding is one of the strongest effects. It's like a snowball. Snowball going down a mountain gets bigger and bigger, and the snowball is collecting more snow around it because it's bigger. So in that sense, compounding can be awesome if you have time. If you start early, compounding can do magics for you. You will be, by the time you go into pension, you'll be a millionaire for sure. And they say the best time to buy a stock is yesterday. The next best time is today.
By the way, guys, watch my compounding video with the snowball effect on YouTube. You'll see the link in the description. Yeah. Let's talk about SXR8. If SXR8 is one of the all-time highest at the moment, would you still buy it?
Absolutely.
What is your strategy actually?
I buy independently. I usually automate my investing so that I don't even have to think about it. So everyone can invest in this way. They don't need to study finance to understand in depth what's happening with the stock market and so on. They don't need to follow the prices. You automate it. You buy it every month when your salary comes or at the end of the month with the money you have left, irrespective of whether the market is at all-time highs. So historically, the market actually, when it hits an all-time high, there's a very good chance that it's going to hit an all-time high again at least 10 times during the year. So people are afraid. If the market hits an all-time high in February, they say, okay, I'm going to wait and I'm going to wait for it to drop. Fact is, historically, in the past 100 years, usually 10 times the market hits an all-time high. So you keep on buying irrespectively where the market goes. And yeah, it doesn't matter if it's up or down. If it's down, it's nice. You get it a bit on a discount, you dollar cost average.
What is dollar cost average? What is that?
Dollar cost averaging is basically when you buy, imagine a graph which goes up, then goes down, then goes even lower, and then it goes higher. So you buy at different points during the lifetime of a stock or of the market, and you average your position. You buy at 50, you buy at 60. You buy at 55, you buy at 45, you buy at 30, you buy at 70. So your average price is around 50. But when the stock is at 70, means that you have bought a lot lower, so you have made a return based on this. And that's again another beauty of the stock market, that when you buy irrespectively of where the price is, the stock market historically is hitting all-time highs pretty much all the time, as I said, around 10 times a year. So when you average out, you come up on top at the end.
What are actually the risks? Because, when you talk about investments, there's usually a risk involved. What is the risk with this kind of strategy?
Of course. So this kind of strategy is a long-term strategy. It's not a short one. So there is this interesting study which is saying that if you invest for 1 year, your chance to be on profit is 65%.
Okay.
If you invest for 5 years, your chance to be profit is at 90%. If you invest for 10 years, 99%. At 20 years, you're guaranteed to be on top, to earn more than you have invested. Okay. So this means that this strategy works perfectly in the long term. It's bulletproof, basically. You cannot lose money in the long term if you invest in indices. In the short term, though, you might have variations. This 35% in 1 year, there's a chance that you might lose money as well.
Okay, yes. So it's if you want to lock your money for a year to earn some interest, it's a risky strategy because, the market may be down and you have to sell your equities, it's
exactly. That can actually now with ChatGPT and all the large language models and chats, you can make your investor profile. So you can enter your goals. Do you want to save to buy an apartment or a car, or do you want to save for your pension, for your kids? You can say how much you will save, what's your risk tolerance and so on, and you can create your risk profile, investor risk profile, which again typically should be long term. So I don't recommend if you save for a flat or for a car in the next 6 months, you probably shouldn't put your money in the S&P 500. But if you save for a pension 30 years away, definitely go and do it.
What do you think about this FIRE movement, that is being modern and everybody in Reddit and in the other platforms are talking about?
So this FIRE has, as you said, been gaining a lot of traction amongst young people and amongst people who have started investing early. Because if you started in your 20s, by your 40s, you've been on the market for 20 years. So you would have generated some returns. You might have a sizable portfolio, which can basically make sure that you live the rest of your life just with the returns from this portfolio.
Okay.
So many people prefer to retire younger because you're healthy in your 40s, 50s, and so on. You don't want to wait until 65 and retire and sit at home and so on. They want to travel. They are willing to live in a cheaper destination, whether it's Thailand, Bali, or something like this. The idea is you can invest every month, let everything we talked about, compounding, diversification, dollar cost averaging, do its magic. Just be consistent with it. And once you generate enough of a big portfolio to support your lifestyle, imagine you have $1 million portfolio. You've invested, you have saved in your life and you're 40 with $1 million. You can easily retire on this because if the market makes 10% per year, that's $100,000 per year,
okay,
which should be a sufficient amount to live with happily with 2 kids and a wife in Thailand if you want. So this kind of concept is something that many people are starting to follow, and they have this target. How much money do I need to live until the rest of my life happily without work or work optional? You can be a consultant, you can do any type of remote work.
More or less like a part-time job, or just temporary work, maybe 3 months working and then 9 months resting, that
exactly.
Kind of, okay.
Work optional, which sounds like a very cool concept because basically you don't have a boss, you decide what you want to do, you have a portfolio supporting your daily lifestyle, so you basically work whatever brings you happiness, brings you joy,
yeah,
which sounds cool.
You can sell stuff at the food market, you know.
Yeah, absolutely. If that brings you joy, I would love to do it. I would love to go and be a lifeguard in Australia on some remote beach and let my portfolio work for me. Money never sleeps, as you know.
Money never sleeps, but in Australia, there are a lot of dangerous animals there.
Yeah, true. Yeah, this is risk and reward. You risk your life, but you live in a nice location. So,
you mentioned Australia. Your hobby is, traveling. Isn't that an expensive hobby? How are you able actually to, invest every month and keep that hobby of yours?
Yeah. So for me, actually, I travel. I wouldn't say on a budget, but I travel cautiously. I don't stay at extremely expensive hotels. Okay. I always make sure I book my flights in advance to be able to get some good deals. I do a very good research in terms of hotels on, for example, instead of booking it on booking.com, if you go on Google Hotels, you can compare all the booking websites. So you can get a hotel for much cheaper, 20, 25, 30% cheaper than booking.com. And you get the same hotel, same experience. I usually plan in advance. I use ChatGPT and so on. I sometimes budget for the trip. I plan how much I'm gonna spend and so on. I've never shied away from experience which might be expensive, but for me the best way to spend your money is on experiences, not on things. I'm a person who doesn't need that much in life to be happy, so I don't need expensive clothes, brands, and this type of stuff. So travel is something which brings me joy, and I'm happy to allocate part of my budget.
Actually, I wanted to ask you, having a car to drive around is, some people treat it as a necessity. I think it's a luxury. Do you drive a car? What's your take on having a car and using it? Yeah,
in London specifically, most people don't have cars because the public transport is at a very good level. I cycle a lot, and actually I cycle a lot in Burgas, and I noticed that most of the cars in Burgas, there's just one person driving. Burgas is a very compact town. You can cycle pretty much everywhere, but people's mentality is, I need to drive to the nearest shop, even though it's 10 minutes walk or 5 minutes cycle. So this mentality is something which is holding people back. Probably you need the right infrastructure to do it as well, to cycle, to walk, and so on. But car, I agree with you, it's a luxury. It's nice to have it, but for me in London, if I need a car to go somewhere, I can rent it for a day. There are those websites for a day, for a week or so on. And it's much cheaper for me instead of paying insurance every time, paying the taxes on the car. And I'm a big supporter of eco type of driving, whether it's driving. I would buy an electric car probably one day, or I would buy an electric scooter. I would cycle everywhere. But the eco part of it is something I'm passionate about. You said you don't buy luxury brands. Yeah. What about food? Do you buy good food? Do you buy food on discount? Do you buy in bulk? What's your strategy in purchasing goods? Of course, yeah. So in London, the food is, funnily enough, can be cheaper than in Bulgaria. If you compare Lidl, for example, at both places it can be cheaper. But for food, it's one of the things that I try not to cut corners, because food is something important for me as a fan of fitness and lifestyle. It's something that you put in your body, so you shouldn't pick cheaper. But obviously you can find discounts. There are websites in which you can order bulk. For example, I ordered lots of chicken, put it in my fridge, protein, proper bulk. For food, I don't save much. I don't go to very expensive restaurants. For example, I prefer those niche type of homemade cooking restaurants or special ones. I'm not really a fan of Michelin star or this type of cuisine. But on food is something you shouldn't compromise. With your health is number one.
Okay.
So that's it for me.
I personally think the same way. I think food is very important. If you think about life expectancy, one of the most important parts of the life expectancy is what you put in your mouth, what you eat. So I also follow this kind of strategy. For me, food is something that I never try to save money out of.
Of course. And funny enough, when you mentioned life expectancy, there are two types of life expectancy. One of them is healthy life expectancy, and the other one is the actual life expectancy. So healthy life expectancy is going down as well as the other life expectancy, the normal one. But healthy one is important, and it's very low. It's like something like 65. And after this, people are not healthy to go out, exercise, travel, and so on. So when you plan, again, from a financial point of view, you should probably account this in your planning as well, to try to extend this healthy life expectancy span. So spending on things such as food, very important.
I'm sure you had a lot of temptations, crypto, stock picking, some person that you follow saying that, buying some stocks, following their path. What's your take on this?
Yeah. My take is that no one knows what's going to happen in the market. A broken clock can be right twice a day, but no one can predict what's going to happen. No one, not Warren Buffett, not Michael Burry. Many people claim, but many people have been saying, there's going to be a crisis next year. And obviously there will be a crisis in 10 years' time, so they'll be right at least once. And crypto has never been something which I have considered. So as I said, I'm a very conservative investor. I stick to my disciplined plan of investing. I invest very boring. I invest into big ETFs and mutual funds, which are very diversified, like the S&P 500, Nasdaq, DAX, FTSE 100, and so on. I follow mostly this strategy. Crypto has been very volatile for me. There has been too much fraud, accounts being stolen, and so on. And I'm actually thankful to Vanguard, because this is my chosen provider, that it provides me with a very limited amount of funds. So they have something like 20-30 funds, which have been tested with time. They have been verified. They have a very large amount of investors there, but they never experiment with funds. For example, in Vanguard, you cannot invest in crypto, you cannot invest in oil, in gold. I have been tempted. Of course, crypto sounds very cool to make 100% a year and so on. But because I'm sticking with Vanguard and I'm definitely following my philosophy, I do not allow myself to swivel to the left or to the right from it. I'm just sticking with it and playing the long-term game.
And does it pay off, this long-term game?
It does, definitely. My portfolio has been growing steadily. And again, I'm contributing every month a little bit. Okay. And the snowball effect is starting to kick in now. 15 years later, I see the effects. So definitely has been working for me. It might be boring for some, but it pays off in the long term. It's the best thing you can do.
Something that we have talked with you, a very interesting point you have. You don't have an emergency fund.
Yeah.
And what do you do if a situation comes in that needs your, let's say, a medical bill or something that you need the money quickly? What do you do in these kind of situations?
Yeah. Usually I keep a very small amount of money in my bank account, just again for type of emergency which could happen on day to day. What I do is I invest in some liquid assets with Vanguard. So that's the beauty of investing in the stock market, extremely liquid. It's not a house, it's not a car, which might take a month to sell, 2 months to sell. It's not real estate or it's not agricultural land. It's an ETF which is trading every second, the price is changing. So you can literally sell it with a hit of the button, and you can have liquid funds in your account which you can withdraw in 10 minutes time.
That's very nice. What does it mean, liquid? What's this concept?
Yeah, the concept of liquidity in the market is something that many people do not value enough. So to have liquid funds means to have something available to you within a very short amount of time. And actually sometimes banks manage liquidity because they need funds for deposits, for loans, for withdrawals and all those types of things. So they need to have liquid cash. So liquid funds is pretty much cash, readily made cash. And because I have some of my funds are ETFs which are trading constantly, I can easily withdraw them if any situation occurs which requires my immediate spending. Those money are both working for me, they're invested, but they're also liquid, so they're not staying just sitting in my account, not doing anything for me. So that has been working for me since I started investing.
Is that money invested in money market funds, or is it something that's backed by the government, type of short-term bonds, or what is it, this liquid form, if you can be a little bit more specific?
Very good question. Yeah. So many people actually advise, for example, Warren Buffett again, he advised that his wife, once he passes away, he's going to leave to his wife a portfolio of 90% S&P 500 and 10% short-term government bonds, exactly as you mentioned, bonds. For me, I'm all invested into equities because, again, they provide me with the liquidity and I have a very long time horizon. I won't be touching the money in my portfolio until, for example, I need to upgrade my flat or I want to retire and I'm going to live from my portfolio. But for me, all my portfolio is right now in equities and it's liquid. I can sell it straight away.
Have you actually sold some of your investments so far, or you've been only buying?
Funny enough, I've been only buying. I don't know where's the withdraw button on my account. I've never used it, but I know it's very liquid. Whenever you need them, you can withdraw them. I've been doing this because I've been working. So I'm using my salary to support my day-to-day expenses, and I haven't been selling. Again, this is part of my philosophy. If you don't need the money right now, don't sell. Let them do their work. There's again a funny saying that the money in the stock market is like a soap. The more you touch it, the more it starts to disappear. So just let the soap stay fresh and clean and don't touch it at all. Let it do its thing. It's gonna grow.
Very good metaphor. I've read the book, and you probably know this book, Rich Dad, Poor Dad, by Kiyosaki. He claims that owning a house is actually a liability. And I also support that kind of concept. I don't like to own a house, I like renting because I can use the difference to invest in the stock market.
Yes.
What's your take on owning a house? Do you think it's a liability? Do you rent or do you own a place?
Of course, yeah. So I own a flat in London. I bought it 5 years ago, I think.
Okay.
I agree with both points. So let me tell you my two kind of viewpoints. So the first one is I do agree with you and Kiyosaki. A house can be liability because a house doesn't generate, first of all, it's not liquid enough. You need time to sell it. So that's a disadvantage which many people disregard. Second of all, the house long-term real estate is earning less than the stock market. The stock market in the past 15 years, S&P 500 has been delivering 15%. The real estate in some places, especially in London, my flat has been pretty much flat. It hasn't appreciated in price. The next one is your flat is not diversified. Your flat is at one location, one type of a flat, so you don't get the diversification of 500 companies. And the last one, your flat has a lot of expenses attached to it. You pay service charge, you pay gas, electricity, all the other things, which, for example, when you rent sometimes, you can pay service charge, for example, you don't pay. I pay ground rent, which if you rent, you don't pay, and so on.
Okay.
So for me, from a financial point of view, it hasn't been a successful investment owning a flat. The other point of view is people in Bulgaria have this mindset that your house is your fortress.
Yes.
So giving you a peace of mind that you have your own place, you can decorate it the way you want, it will be there forever, you can start a family in it, something extremely valuable which many people disregard. It gives you this peace of mind, it gives you the comfort which cannot be measured by money. And being mortgage free, for example, is something again which can feel very nice because there's no outgoing money from your account every month. Another thing is that you can use the leverage that we talked about. You can put 20% deposit and you can own 100% of the flat. So if the price of the flat increases, let's say by 10%, you earn 50% on this, which is a very on the 20% you've put, which is another thing. You again can win a lot of money with it. So there are two viewpoints, but for me, from a financial point of view, it hasn't appreciated. If I invested this money in the stock market, I would have been much better off.
I understand. I've read this article that Warren Buffett actually said the same thing, that, you know, owning a house is going to be much more expensive than, you know, putting the down payment, for example, in the stock market. And, you know, in the long run, this down payment would have, you know, with the compounding, it would have grown a lot more. But people are emotional, and, you know, we as emotional creatures, if you can say, we need, as you say, a place to stay. We consider this house a fortress, and buying a house is purely emotional decision. And I think even I want to buy a house at one point, but I want to make sure I run the numbers and do it as logical as I can, because, you know, buying a house and getting this high interest rate is not good.
No, Warren Buffett, he's been living in the same house in Nebraska his entire life. He's a bit of a cheapskate, I would say,
he is,
but he's been successful. You cannot deny it. The greatest investor ever.
Another thing I want to ask you is, you mentioned that you've been building this portfolio for quite some time. Have you noticed a change in your thinking, a change in your mindset over building this wealth over the years?
Yeah, absolutely. So when you start, funny enough, when I started my first job and when I invested my first stock, I invested in a fund which is called income fund. So there are two types, income and accumulation. Accumulation is reinvesting the dividends in your portfolio automatically. The income one is paying your dividends to you or to your bank account. When I started in 2013, my income was being distributed with a bank check in my post. So I remember my first bank check with my first dividend, which was something like £10, which came to my post. I opened it and I saw £10 and it was the greatest feeling ever. I had just earned £10 from the market. It's like free money. It was amazing back then. After this, you see your portfolio starts to grow, to generate more money. Those numbers start to become meaningful. Like you can buy, I can buy a TV with those money. I can buy something bigger. And they say the first 100,000 which you earn in your portfolio are the hardest. You have to wait the longest, grind, save as much as possible, and so on. And after this, it becomes easy. So when you start seeing some bigger numbers, some actually comfortable numbers, which are as much as your salary, sometimes it can be if your portfolio is big, then your mindset starts changing and you start realizing how important this portfolio is and how valuable job you've been doing during all these years to see your portfolio grow and pretty much match your salary, which must be amazing. Those people who reach their fire goal and they say, okay, I can live the rest of my life with this portfolio, then again, it's a completely different mindset. You start being very calm, very relaxed with it. Of course, in the beginning, you're nervous, there are emotions around it. But once you automate this process, it becomes part of your life. It's like training, routine. You just go do your workout 3 times a week. You don't even think about it. So that's been my story so far.
Do you still receive checks in the mail?
No more. Now it's all automated. I'm a big fan of the accumulation fund because exactly of the snowball effect. Because those indices, for example, the S&P pays you around 2% dividends. Okay. Those automatically get reinvested in your portfolio. So imagine if you've been investing for 15 years, 2%, and again multiplying, it's probably 30-40% of my portfolio right now.
So how is this actually shown? Is it the price of the index that's lower, or is it the shares that you get? How is this 2% accumulated? Have you? Do you know how it works?
Every year on a certain date, they pay this percent, and the price of the index goes up. But you cannot buy the day before and then basically benefit for it. They account for how long you've been holding the index, so they give the dividend based on how long you've been holding it. So if you've been holding the index for, let's say, 1 day, they would give you 1/365. So for 1 day of the year, they would give you that dividend. So it would be very small. But if you've been holding the fund for the entire year, you get the entire dividend.
Okay. Have there been years where it was difficult for you to invest, switching jobs or some things that, impacted that? What did you do?
Yeah, it's difficult. Sometimes on a bad year in the market, it's difficult to kind of see the big red numbers in your portfolio.
Yeah.
To see, I've been through some big drops. For example, I remember during the Greek debt crisis, markets fell by 8%, and it felt absolutely awful to see your portfolio be a complete bloodbath. So for me, investing has taught me a lot of discipline, a lot of patience, mentality to think of long term, not just to look at the short term. Another thing is not to check your portfolio all the time, because that's when you invest long term, short moves don't matter. If the stock market falls by 5% this month, 5% next month, just keep on going, keep on patiently investing, and you'll be on top in the long term. So yeah, to control your emotions, to avoid the fear and greed, to avoid side distractions or big spendings and so on has been very useful for me.
Okay. Why are people afraid to invest? Let's say, for example, in Bulgaria.
Yeah.
What are the myths in investing, in your opinion?
Yeah. There are a few reasons. So people in Bulgaria, first of all, I would say the financial education. People in Bulgaria do not study personal finance at school, which I believe is a big gap, because this is something that every person would need, whether it's your mortgage or your loan for a car or anything. Everyone needs to understand how simple interest works, how deposits and loans are done, and so on. So they think that stock market is something very dangerous, very risky. It requires a lot of money. While it's not the case. Even with $1, I think in the platforms like Trading 212, you can start investing.
I think the minimum is 10. I'm not sure.
Simple. Everyone's got $10.
Yeah.
Whether you eat a doner kebab or invest, just give it a try investing.
Or drink a cafe with your friend at Starbucks,
Absolutely. Yeah. But yeah, the myth is that you need a lot of money and only rich people do it. Definitely not the case. It's very complicated and only extremely smart mathematicians can invest. Not true again. You can invest in a very simple index fund and you can make money out of it in the long term. Another myth would be that you will lose all your money. It's paper money. It is something artificial which doesn't exist. It's somewhere out there and only rich people can do it. Again, not true. Bulgarians probably have this mentality because they have seen a few defaults of the banks. They have seen the hyperinflation from 1997. So they're very afraid. They love cash, Bulgarian people. They love to feel the money and not to put them somewhere out there in the stock market. That's another myth.
I think they don't trust these online platforms that they have digital numbers. They need to have a place that they can touch, they can see, rather than just some digital online stuff.
Yeah, absolutely. The issue is with this is that inflation is eating your money if you keep them under the mattress or in the bank with 1% or 2% interest a year. Inflation, as you have seen in Bulgaria, has been very, very high in the past years. The official figures are low. They're like within 10% or a lot less than that. We've seen that some prices have doubled. So inflation on some products could be 100%. So this money that you own, next year, if you own this €100, next year they could be worth €50 in essence. You can buy twice as less of a product than you can buy now. That's why investing is so important, making your money work for you.
Yes, I agree. People underestimate the power of compounding because they can't see the effect that quickly.
Yeah.
Nobody wants to become rich, slowly in 5 and 10 years. They want to become rich today or tomorrow. They invest in crypto that no one has heard of, and then the next day they lose 50% of their investment. It's ridiculous.
It's like a lottery. It's gambling pretty much. So investing is not gambling. Investing is a very strategic move, which you have planned. You have a time horizon. You have a profile, and you have your amount of money, which cannot be lost. So it's not like you're putting some money, let's say, on a football game. Tomorrow, if they lose, you lose the entire amount of money. That's the main thing. While here you have something which is staying there. It's solid. It's not just numbers on a screen. It's you buying the 500 largest companies in the world. So you cannot just lose your money like this with a snap of a finger.
Can you explain to me how this works with buying these 500 companies?
Yeah.
When you buy one share of this S&P 500, how does it work?
What they do is they replicate the fund. S&P 500 is a fund of the 500 largest companies in the US market, sorted by market capitalization. and they change very often. I think every month or every 2 months, a few companies drop down and a few other companies join, which are getting bigger. So what you're buying is one fund, one simple asset. It trades as a stock actually on the market. It is one ETF or index fund, which has invested in all those companies. So what they do is they pull the money from all the investors, which have invested on them that day. And on the next day, they automatically buy those companies in the proportions of their size. For example, Nvidia and Apple right now are the biggest ones, around 5-6% of the index.
Okay.
So they go with that £100 you have invested or $100, and with 5 of those dollars they put in Nvidia, 5 of them they put in Apple, 4 of them they put in Google, and so on.
Okay.
So they buy proportionally to it.
The S&P 500, it has a very big exposition to the US market.
Yes.
Some articles and some, let's say, investors claim that, America is not guaranteed to be the biggest country in the world, and not going to. There's no guarantee that their investments will grow as much, let's say, as for example UK or let's say Japan, because UK 100 years ago was one of the biggest countries in the world.
Absolutely.
And Japan 20-30 years ago had some very well-performing companies. What do you think about that, actually?
Yeah. I think the word here is diversification. And by the way, go and watch Mitko's video on diversification. Very useful.
Thank you, Chris.
But diversification is the key one. As you said, superpowers in the world, they change. British Empire, Japanese, now US is on top. US is very concentrated in artificial intelligence stocks, so you're exposed to those data centers and so on. That's why I try to diversify globally. So I have big chunk in the US. If you invest in a global fund, because the US stock market is so big, 60% of your money go in the US.
Okay.
So what I do is I invest some money in S&P 500, some money in Europe. Some of my funds are emerging markets, Japan, and so on. So I try to diversify globally. So whenever the new superpower emerges, I will be invested in it.
How are those actually emerging markets, as you said, Europe, how are they performing comparing to America? Are they performing well? Are they correlated the same when a crisis in America happens?
Yeah.
What have you noticed?
They usually have relatively high correlation, but for example, Europe has been outperforming the US in the past 2 years, and many people don't know that, but Europe has a lot of stocks which are defensive stocks. The military industry right now is using a lot of armory companies and so on. They have a lot of banking companies, a lot of healthcare companies. For example, recently Moderna, I believe, they have found a drug against one type of cancer, against the skin cancer.
Yeah,
they have jumped massively, like 200%. So if you buy a fund in Europe and you buy European healthcare companies, they can jump massively. So that diversification helps a lot. I don't know which one is going to be the next superpower, but being invested in a variety of funds, I cover the entire globe, from Malaysia, from semiconductors in Hong Kong or in some other countries, in Singapore and so on. I try to get a global exposure, and that helps me kind of not be so exposed to the US market, because, with Donald Trump, anything can happen with a snap of a finger.
When one of the companies from the index fund drops, let's say, defaults.
Yeah.
Let's say, for example, Nvidia tomorrow defaults. What happens to the index fund?
So the index fund survives, basically. So what the index fund does is dynamically includes and excludes companies. So whenever a company falls in price, it will be excluded, and another company which is rising in price will be included. So that's kind of a natural filter to companies. You only get to invest in companies which are high quality. They have been verified, checked by S&P. They need to cover some criteria, like to have revenue, to have generated positive revenue in the past how many years, profitability, and so on, this type of criteria. So that kind of ensures, without you being an expert into finance, that you invest in companies which have been doing well. So it's kind of a trend following strategy. It's not a contrarian strategy to invest in a company which has been dropping. But as I say, I believe that no one knows what's going to follow with the market. So when a company drops, it's not a guarantee that it's going to go back up.
Yeah, okay. Mm-hmm.
And many people, funny enough, when we speak about psychology of investing, many people are thinking that, okay, I've bought this company for $100. Now the stock price is at 50. So I'm going to wait for it to come back to 100. And after this, I'm going to sell and I'm going to be break even. That's not the mentality. The only thing which matters is where the company is trading today. No one cares if you bought it at 10 or at 100. The market doesn't have memory. The market is only forward looking. So people should get rid of this bias to think that I bought a stock high and now it's low, that's why I shouldn't sell it. No, only thing what matters is, do you think the stock is gonna go up or down in the future? If you think it's gonna keep on going down, sell it.
Yes, because you can use the money to buy something that, you know, is gonna generate you stuff.
Absolutely.
I personally done these kind of mistakes when, you know, I buy a company and it goes down and then I wait for it to go up, and it doesn't happen for years.
Exactly.
So, you know, if you have an exit plan, you know, you need to follow it. I think greed and fear are those emotions that drive the market in a short term. I have a lot of people who are asking me, what do you think about Nvidia? What do you think about Netflix? You know, my question back at them is, what do you think about Netflix?
Exactly.
Because if you're buying based on my judgment, then tomorrow you're gonna ask me, is it time to sell? You know, so exactly, I can't just hold your hand, you know, all the time. So
no, of course.
I think everyone should have a strategy, and if something doesn't perform to the extent of the strategy, maybe it's time to move on.
That's why many people put a stop loss. Like the day traders, they always have a stop loss because you can get very emotional. You can hold a stock which is falling, like catching a falling knife, they call it. So you can try to catch a falling knife, but you can catch the knife and get blood on your hands. So you don't want that to happen. So you've got to have the strategy, follow it. And yeah, you shouldn't just hold a stock because it's fallen down and you think it's going to go up. That's for sure.
Just a quick one, guys. None of this video constitutes any financial or investment advice. Always do your own research, and this is for educational purposes only.
And do not listen to your friends, because they're not always right.
And if you like this podcast, tell me what you think about it in the comments. If you like to follow this kind of videos and get this kind of investment knowledge, you can subscribe to my channel, Dimitar Money. Thank you guys for watching. Chris, thank you very much for coming today.
Good to be on.
Sharing your knowledge. And I'll see you on the next one.